Welcome back to another week of the Educated Homebuyer Live with Josh and myself here to update you on the economy, real estate, mortgage, everything that's going to affect you to become a homebuyer in 2025. And at the same time, we're going to answer your mortgage and real estate related questions. Josh, welcome to the show. Happy Wednesday.
Jeb, you said in 2025. What if someone wants to hustle and get it done here in the last 20 days of 2024?
We're going to tell them if they're not in escrow now, they're not going to close in 2024.
Come on, Debbie Downer, pessimist.
We are here to help you in 2025. So with that, guys, let's see what we got here. As you'll see, my background's a little bit different. I'm working from home. I had the stomach flu, Josh. It's not been fun. It's 2 days of pretty much hell.
Working from home, aka quarantine. So I'm just hoping. So Kasim had it and was down for 2 days. Now you've had it down for 2 days. I am opting out. I do not want to have it.
Yeah. So are you saying there's a possibility that Kasim passed it along? Is that
he had it like a month ago? It's quite a delayed reaction if you're just coming down with it now.
All right, that's fair. That's fair. All right, so we don't have a lot of people on at the moment, but we're going to do, as we always do, start diving into some slides, and then we'll start answering your questions. So in the meantime, let us know where you're watching from. Also start putting your questions in the chat so that when we're done here, we can actually dive directly into your questions to keep the show flowing. With that, Josh, let's do this and add these to the stage right here. So I changed it up a little bit. Instead of talking about inventory to start with, I want to talk about house prices to start with, Josh. What to expect from U.S. house prices in 2025. So this was a slide put out. It was on Resi Club. And what they did was they essentially, aggregated. There we go. I was going to say analyzed, aggregated everyone's data. And what we have is on the high side, Apollo Global Management estimating that house prices are going to increase about 11% in 2025. And on the downside, on the low side, you have Moody's basically at flat, minus 0.4%. So less than 0.5%. So essentially flat. So on the average, Josh, you got 3.5% appreciation in 2025. What are your thoughts on that?
I like the number. When I look at this, I don't know who Apollo Global is, and it's such an outlier. I'm happy to eliminate them. Moody's is reputable, so you don't really, and they're not really an outlier. They're in the range of what everyone is looking at. Housing Wire, friends of the show, Logan had a say in that, along with Mike Simonson. So good data. CoreLogic has always come in pessimistic on the low side. Zelman, pessimistic on the low side. You look there, National Association of Realtors and Mortgage Bankers Association, those are both trade groups. You wouldn't think they would be pessimistic. So when you're looking at it, I think that's reasonable. And I'll tell you what, versus saying who is accurate or who is right, because no one's crystal ball is better than anyone else's. When I look at that data, I say I would love for CoreLogic to be right, somewhere right in that range, somewhere between 2 and 3% for next year. I think would be ideal. It would keep people from getting scared and understanding that home prices are going to continue to go up without making things any more expensive than they already are, and hopefully combined with wage growth, moderation in interest rates, we'll see a better affordability picture next year.
Agreed. Yeah. And in real terms, you're talking basically flat, right? We got CPI today, which we're going to take a look at. And CPI, depending on which measure you're looking at, somewhere in the mid 2% to 3% range, right? I mean, if you average the two, which you don't average the two, but core is just over 3 and headlines just under 3. So, when you take that in real terms, you're basically talking about flat home prices moving sideways. So, for all the crash bros out there, this feeds right into what they want to talk about and the market that they've, been preaching for the last 5 years. And the reality is home prices are flat, right? You're not going to see this gangbuster growth, and you're not likely to see any huge decline. So you're basically just going to see things kind of chug along. Wage growth is going to continue to increase, like we said. Hopefully we get better interest rates, which is going to improve affordability. But at the end of the day, house prices aren't likely to be getting any cheaper, especially in nominal terms. So, Josh, let's take a look here at inventory. Let's dive in.
We are getting a slew of great questions popping up. Sadly, none of them are housing or mortgage related, but some really good questions.
Oh, well, even better. I mean, I actually dislike talking about housing these days, so I'd rather talk about something else. So let's do this. We got a bunch of slides, so we're gonna zoom through these pretty quickly. So what we have here on inventory front is inventory actually fell from 706,554 to 690,000 homes. We got 26% more homes on the market this year than the same time last year. Is this abnormal? Is this anything to worry about? No, it's seasonal. We talk about it every single year. This is essentially the same information that we just talked about, just breaking it down a little bit further. But you can see the all-time low was back in 2022 at 240,000 homes. And our peak was just a couple of months ago here in 2024, sitting at 739,000 homes. So these are single family active properties nationwide, which is going to take us into Huntington Beach. So in Orange County, we always like to look at this data because this is where we are. Orange County sitting at 2,916 homes, which is down almost 4% week over week. And Huntington Beach is actually down exactly 4% week over week, sitting at 200 homes. My guess is these numbers will continue to dwindle through the next coming weeks. This is taking a look at the second week of December with calculated risk. I just drew a red box around the ones that are somewhat anomalies in this whole thing. This is active inventory. So this is properties that are currently on the market. When looking year over year and compared to 2019, you've got Charlotte, Denver, Jacksonville, Nashville, and the Northwest region, if you will, having growth both year over year and versus 2019. Some of the outliers on the other side is Albuquerque, still down nearly 27% in inventory versus 2019. New Hampshire down almost 50%, or down 50% since 2019. San Diego down 46%. So the markets that are still down versus 2019 are the markets that are still doing fairly well. Those are the ones that we still got some competition. You've talked about clients, Josh, in San Diego. We have a lot of people here talking about the Northeast and how crazy that is. Basically, this plays right into it.
My favorite one is seeing San Diego, and not favorite because it's frustrating because a lot of people want to go there. A lot of people, our clientele is there, and it's a tough market for them. But we talked a little bit a few minutes ago, that CoreLogic unnecessarily pessimistic most of the time throughout COVID. They were predicting price drops while values were going through the moon, and they put out a list this week of the 5 or 10 markets most likely to see a correction, and San Diego was in there. You're like, that's interesting when your inventory is down 46% relative to the last semi-normal year we had. I'm not sure how we're going to see a price correction.
Agreed. So new listings nationwide, only 31,000 new listings during Thanksgiving week. Now, remember, this data is delayed a week. So, but at the end of the day, it's not really anything to concern yourself with. Basically the note here is that the previous year Thanksgiving was actually the week before. So you can kind of see there on the chart, what's that big dip on the chart the prior week? Well, that was Thanksgiving last year versus this year. Similar drops both years. Taking us into new listings, same chart from calculated risk, just looking at new listings again. Charlotte, Jacksonville, two of the same ones that had active inventory. Whereas, still the outliers on here that we've talked about are still down, versus 2019, Albuquerque, San Diego, Portland, Northwest, the whole Northwest area, New Hampshire. Now, this is new listings coming to the market. This is a slower time of the year, so you're not expected to see a lot of new listings this time of the year. So this is probably less of something I would really concern myself with and focus more on what's actually on the market versus what's actually coming to the market at the moment. Total pending sales, we're hovering 12 to 13% more contracts than at the same point last year. Percent of properties with price reductions currently sitting at 38.4%, which again, pretty much right in line with 2023. And then that takes us into inflation. So Josh, today was inflation day, and basically what we got was a big blah, right? Everything came in exactly where we expected.
Yeah. So they were both expected to come in at 0.3, came in at 0.3, 2.7 here on the headline and 3.3 on the core, both exactly as expected. So I gave it a little different chart than what we normally look at. This goes back to 2020. So you can see we are still elevated way down from that COVID spike, that kind of the pig that worked its way through the python there, but down 2.7 is still higher than anyone wants to see it. 3.3, we see on the core, we have not seen as much improvement. We'll always like to look here at the month over month because it shows us what's coming up. So we have December is a 0.2. So if we get another 0.2, 0.3, I didn't throw in, Jeb, the nowcast for what they're projecting for next month, but they're projecting dangerously close to a 0.4 for next month. So if you have a 0.2 fall off and a 0.4, you're seeing here that the numbers are kind of stalling out. I don't see inflation reigniting or becoming a problem, but definitely stalling out. What we're hoping here is the number that we saw today that was helpful is that finally shelter inflation somewhat started catching up. So showing you here in January, February, March, we have 2.3s and 2.4s falling off. So if we can get some 0.2s, you could see some nice improvement in the annualized rate in the first quarter of next year. This is the core. The core, again, has some high numbers falling off, but we've been here pretty consistently 4 months in a row at 0.3. So it'll be interesting to see what happens going forward. But again, the bright spot, the good news, we had a little bit of improvement in interest rates, treasuries and mortgage rates early this morning. Gave most of it back in the afternoon after a solid 10-year auction, which is a little bit surprising. But multiple different measures here. The purple line is the apartment list national rent index. So when we look at that, the CPI rent of primary residence, that's the figure, one of the figures that is picked up inside of the CPI figures is that teal line, blue, whatever we want to call it. And you can see it was very delayed, very late picking up the spike in shelter costs. And it is late here in absorbing this because you can see it went up slow, much slower, and never peaked at as high a level. And now it's coming down much lower because we're seeing year over year decreases in rents through apartment list. Here's multiple different measures. So we talked about rent of primary residence. The green line is rent of shelter, owner's equivalent rent of primary residence. We can see the trend is absolutely correcting there from the peaks in late 2023. It's just taking a long time to pick up in the metrics that we look at. So Jeb, you sent this over here earlier today, shelter inflation. So in looking at this is the BLS housing metrics and then the change using real-time metrics. So the real-time metric here, how are we defining that? An average of the Zillow rent index and apartment list. So averaging those numbers out, if we look at that, shelter inflation has been 1.23% over the last 12 months, and we're looking at a 4.8% figure in what we're seeing in CPI. So what would we be looking at if it were picking up actually where we are? It's not the way it works. It didn't work that way. It artificially gave us a low number on the way up, and it's artificially giving us a high number on the way down. But the headline inflation rate would be at 1.53 instead of 2.7, and the core would be at 1.77 versus 3.3. So we saw some nice improvement today. It was expected that the shelter component was expected to be at 0.4, came in at 0.3. If we continue to see some moderation, that will improve. Jeb, we had last Friday, so we've been, you and I have been talking, the two primary drivers of interest rates and affordability going forward are going to be the jobs market and inflation. So the Fed's preferred measure is PCE, but the market definitely trades CPI more. So last Friday and this Wednesday, the two most important numbers of the month. So unemployment also came in, or the employment figures from last week came in about as expected. What were they, about 20,000 hot, Jeb? A little bit, but the market again shook it off about as expected. So the unemployment rate about 4.2%. And I wanted to show you this. This is going all the way back to 1990. We've had 3-4 periods here where we've hit this level. It's not normal. And if you go back, 2017 is when we hit that 4.2 level. And if you take out the COVID spike, we've had really low unemployment for quite some time. What does that do? Payroll changes at establishments. So why does the Fed care about really low unemployment? They worry there's not enough slack in the labor market. Employers will have to pay too much for employees and have too high of wage increases. So this is payroll changes at establishments. The red is the 3-month average. The blue is sort of the noisy month over month. You can see if we look at a 3-month moving average, definitely moving back down to that normal level that we saw from 2015 to 2019. So unemployment low, wages growing, but not out of trend the way they were. This is average hourly earnings. Average hourly earnings are still elevated. So we're up there at 4.5%. One of the reasons why I wanted to put this in, Jeb, is we had a comment at no one wants to, everyone has a bias. So you're reading the doom and gloom news media and everything's terrible, or you're reading this and everything's perfect. And we got a comment in here, and it was basically, and it was a question comment all in one. It says, do you realistically think wages will go up? I mean, everything we see says no. And I says, everything we've seen says no. We're going to look at a couple different measures here. You can see since 2015, we've been above 2% at all times, and in periods of time as high as 6% wage inflation. So inflation has been high, but what most people don't realize is that working people's wages have also increased. This is the Atlanta Fed does a wage growth tracker. This goes all the way back to 1998. We've had 2 recessions, 2.5 if you want to count COVID. And Jeb, you look at this, we've never gone below 2% wage growth. So 2% wage growth, 2% inflation is basically static. You're not seeing any wage growth. This is nominal, not real. So if we look at it and we're at 3.3% on core inflation and wage growth is at 4.7, you have 1.7% real wage growth. And going back through recessions, through 25 years, wages go up. They go up. They're going to go up next year. They'll go up the year after that, even when we hit a recession, even through the Great Recession. So when we say things normalize over time, that we could see 0, 1, 2% home price appreciation while wages go up at a higher rate and interest rates come down, affordability can absolutely normalize, return to a more normal level without seeing a home price crash. This one, just again, another measure here, median duration of unemployment. So when people lose a job, you see it's less than 10 weeks. Most people are back on the jobs. Not only are they making more, not many of them getting fired, let go, losing their jobs. Those that do are not on unemployment all that long. What does that mean for us, Jeb, here in terms of interest rates? I forgot to throw in the chart on Fed funds futures. It's at 98.5% chance that we're going to get a cut next week. So when you see it that high, it's very, 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 very rare that we're not going to see that cut. I was also looking, Jeb, at the implied cuts for next year, and they're implying now 2 cuts, 25 basis points through the entirety of 2025. And that was down from expecting 3 by the end of the year and then 4 next year. So we'll see where it goes from here. Well, what we want to show with this, we're in the purple lines. There is a range. We're near the high of that range, but we have the downtrend line, the green. As long as that holds, we're going to see rates continue to go lower. There will be a floor there at that red uptrend line until that wedge breaks one way or the other. In terms of actual interest rates, up day over day, down week over week, but negligible. We're pretty much exactly where we were a week ago. 30-year fixed about 6 3/4. FHA and VA just over 6%. As we always say, those of you that are well qualified, those of you that are working with a good broker that has multiple options can get you terms better than that.
All right. And then lastly, for those of you who already have loans looking to refinance, waiting for rates to come down, instead of having to watch rates all the time, we can do that for you just by going to jebsmith.net/rate watch. Fill out a couple basic questions. We'll need a little bit of information from you. And then as rates move down to a level that you feel like is reasonable, our team can reach out and actually have that conversation with you versus you having to watch it every single day. So do that. And more importantly, if you need to get in touch with us now, there's a referral link scroll on the bottom of the screen, jebsmith.net/referral, which will get you in touch with us. That said, Mr. Lewis, let's start answering some of these fun questions.
Can I just jump to a question that will underline exactly what I said? So Drew follows up in New York, a home that was 400,000 is now 600. At this rate, in the next 4 to 8 years, these homes will be 800 to $1 million with stagnant income rates. I literally just showed you the chart that over the last 25 years, incomes have never stagnated.
Yeah, but the problem, Josh, is people don't feel the increase, right? They get a little bump in wage, they go up, $1 an hour or whatever. But prices have gone up $3 an hour on whatever it is that not $3.
But the numbers don't.
$3
the numbers don't bear that
whatever.
out, Jeb. They don't.
I
just don't. There are things we can all point at the one thing. Like I was probably 3 times a week. I'm no different than anyone else. There's probably 3, 4 times a week. I'm like, what are we doing here? How does this work? But when you look at the numbers, unless we're going to be conspiracy theorists and say, oh, the government's cooking the books, all of those numbers are unreal. You have to acknowledge that we have seen real wage growth above trend over the last 2 years, while people are saying there was another comment on this week's video, Jeb, said, oh, where I am, there's no jobs available and everyone's unemployed. I'm like, did you find the one pocket of America? We do know that there are regions that the economy is worse, that, they've had jobs leave. So it could possibly be. But for the most part, a lot of it is what channel of news you watch is going to tell you what your belief or take is on this. The data is out there. Go look for it and look at it from a realistic lens. 400 to 600. Okay, so it went up 50% over what time frame? Probably from that 2019 timeframe over the last 5 years. Is that way above trend to see 50% growth in 5 years? Hell yeah, it is. Do we want to see that going forward? No. Will it be seen going forward? As long as we have limited supply relative to demand, it's probably going to exceed the rate of growth that any of us want to see, but it's certainly not going to be another 50% over the next 5 years.
Agreed. All right. Josh, we had we often get questions on down payment assistance. Down payment assistance is tough to talk about in multiple states, right? We're located here in California, Southern California to be exact. Down payment assistance is across the United States, and it's different. What most people don't understand is it's not like a loan program, like a conventional loan or an FHA loan or a VA loan or USDA loan. Those loans, the guidelines spread nationwide, right? They're the same in every state. The only thing that changes is the loan limits. Down payment assistance is different, not only in every state, every county, but sometimes in the city. So depending on where you're located will dictate what programs are available, how much is available. There's just a lot of nuances to this thing. So it's very, very difficult to give anyone any guidance on it. What I would say is find somebody that's really knowledgeable in your market that knows down payment assistance. There's typically people that specialize in down payment assistance. Those are the people to deal with because they understand it in more detail. There are some programs here in Southern California, LA County, Orange County, that aren't down payment assistance, but grant specific, anywhere between $20,000 and $50,000. Josh talked to one of our friends today about this program. So if you're looking for grant, you're in Southern California, reach out. I can give you some more information on that, but down payment assistance is tough to talk about. And so unfortunately, we're not going to be a really good source for you right here.
And that program you're talking about, Jeb, is pretty limited. And it's mainly geo. And if you're eligible for it, fantastic. It's a great program. But when we're talking about assistance, most of the housing finance agency assistance programs, people do them. They go, I don't really have a choice. I got to do this. I got to go in. And they're like, I got this elevated rate. I'll refinance out of it. Well, if we don't see some above trend in appreciation in home prices, the people that I'm talking to that want to get on the rate watch, that they send over 2 mortgage statements, it's their first and the second from the assistance. None of these housing and finance agencies will subordinate. They want their money back. So they're giving you an above market interest rate, which basically should be paying for that assistance, but it's not. There's a lien there. And some of them will forgive it over 5, 7, 10 years. Some of them never forgive it. But the big issue is if you're at 7% and an FHA is at 5.75 today, 5.875, and you want to do that, if you don't have the appreciation where we can get an appraisal, you're not going to get it. So again, you say, I'm not shitting on what you said, Jeb. You're saying go to one of these people that specialize in it. What happens is the people that specialize in this, they push it really hard. They tell you what a wonderful and great thing it is. And they do not tell you that when it comes time to refinance, you better hope the thing went up 5 to 7%.
Good point. If you know, I don't really deal with a lot of down payment assistance, if we're being honest. It's not a popular thing here where we're located. So with that, we got a couple of questions coming from the same person that I'm just going to kind of lump in here. Josh, we got one person being told they can't qualify for an FHA loan because one of their jobs they don't have a 2-year history on. So I'll let you jump on that. And then one of them was told, or the same person was told, that if they pay off 2 auto loans they have on their credit, then they would qualify for basically more. How do those things affect your eligibility in buying, whether it's FHA, conventional, what have you?
So look at the second job issue. FHA, they're hard and fast. They want a 2-year history of it. They're not going to make an exception. You might get an underwriter to bite at 20 months, 22 months, something like that. We're really, really close to the 24 months. Conventional can entertain it with an otherwise strong file after 12 months. So you may want to look at conventional. We have this question all the time, Jeb. You and I have this discussion all the time, conventional versus FHA. Anyone with this credit score 740 or below is generally better off with the FHA. But when you get to a situation like this, don't hit a hard stop when you say, hey, let's look at it and go, you've been on the second job for 14 months. Can we make that work? Then in terms of the payoff of the auto loans, can we make the payoff work? Can we pay one off? That's if you're only qualifying for 70 and you're adding $80,000 of qualification, it's about $6.50, $7 per thousand, depending on where you are in the country. On the low end, let's call it $6. That's $480. So are those two auto loans $480? Where are we maxing out? It really solely just comes down to a debt to income ratio. So paying off an installment debt, we can always do that to get you qualified. In some instances, we can just pay it down under 10 months. We closed one on Friday, Jeb, for listeners of the show. It started with someone who did a horrific job of pre-approving them, got them into escrow, and then 10 days later says, oh, the underwriter wants to know this. And you're like, dude, did you not even read my loan application? 10 days later, we want to do this. And what we were able to do is they had an auto with, I think, 14 months remaining on it. So we paid it down by 4 months. So there were only 10 months remaining, got them under a 50% debt to income ratio and got in. So there's ways of working with it. But what I would say is I get calls all the time from people that are telling me, oh, we've hit a dead end or we're told we have trouble. And it's like a 3-minute phone call of diagnosing and figuring it out. So when we say it is important who you work with, it's important who you work with. I have a client, Jeb, a listener to the show that we refinanced earlier in the year, and he replied to a mailer in his mailbox on an FHA Streamline and said, oh, they're telling me that I should do this. I look up, they'd actually sent him a loan estimate. So he didn't just have a phone call. He had got fairly far into the process with him. He sends over the loan estimate. We closed his loan in April. The person that he was talking to from the mailer got their license in May. I'm like, dude, this person wasn't even doing loans when you got your last loan earlier this year. So it's important when you're looking at these guidelines that you're dealing with someone that knows how to ask you the right questions and then knows how to not manipulate, but work their way through the guidelines to get you what you need.
All right. Let's see. A couple questions here. Here's one that just popped up, Josh. Interesting question. Says, new construction in-house loan officers have not been factoring in deferred student loans into DTI. Those who took 321 buy downs with reassurance probably won't be able to refinance equals distressed sellers, ? So an in-house lender, Josh, do they sell their loans or do they typically keep them? And if they are selling them, are they using Fannie Mae and Freddie Mac's guidelines, which means it's factored into the income ratio?
They're all going the same places. The builders, lenders are doing Fannie, Freddie, FHA, VA loans. They have to follow the agency guidelines. So there is no builder on the planet that has a mortgage company that's loaning their own money and says, hey, we're just going to ignore your student loans. So no one has been ignoring student loans. They have to meet the guidelines. So if we have a $0 income-based repayment plan, can be okay under certain guidelines, but we have to document that it's truly a 0 IBR, that it's not in forbearance. Freddie's going to be 0.5%, Fannie's going to be 1%. So just depending on what type of loan program, they are going to get used. And in terms of a 3-2-1 buy down, same thing. 3-2-1 buy down, 2-1 buy down, 1-0 buy down. You don't get to qualify at the bought down rate. You are qualifying at the fully indexed rate. So if rates are 7 and you're doing a 3-2-1 buy down starting at 4%, they're not qualifying you at 4%. All it does is get you a payment that you're comfortable with. It doesn't allow you to qualify for more home. That stuff went the way of the dodo, 15 years ago during the Dodd-Frank sort of re-regulation of the mortgage industry.
Good stuff. All right. Miss Taylor asked me about my beard. Says she watched a video 2 weeks ago and had no beard, and now it's back in full beard. And 2 weeks later, you must have watched an old video. It's been here for some time. So it doesn't. Unfortunately, I can't grow it in 2 weeks. If I could, I would shave it a lot more often. But it's probably I don't know, 6 weeks or so. Josh, I have no idea. But anyway. It's what it is.
I don't let mine grow anymore because it gets grayer and grayer. So the more it grows, the older I look.
Yeah, I just figure what the hell at this point. Married, kids, not really. What am I even doing?
What's funny is you have like 100 times more gray hairs in your head than I do, and you have like 1/1000th the amount of gray beard hairs.
And it's thinning. It's it's not looking good, Josh. 50 is not going to look good. That's 6 years from now. All right, here we go. Let's see. Drew says, Jeb, from your last video stated that most of Trump's policies would equal higher home cost and higher rates. What policies would you put in place to both lower rates and lower home prices? So the video that I put out essentially put things in place as to the way the market believes they're going to have an impact, that basically higher inflation is going to lead to these things. Not necessarily my personal beliefs, but at the end of the day, pro growth, a growing economy in theory leads to a more stable economy, which likely leads to interest rates not moving down in a considerable way. That's what I struggle with, I guess, more so than anything else, Josh, is how do you have a super strong economy and low rates at the same time? Does it happen? Can it happen? I guess it can. I have a short memory of how these things impact. So in order to see lower rates and lower home prices, you need a shitty economy. You need an economy that is struggling to produce jobs, an economy that's inventory is growing, people aren't buying homes. That's how you get lower home prices. Like that is what you need for what you're trying to get there, to get both of those things at the same time, which isn't reasonable in my opinion. You might be able to get one, but you're not going to get both.
The thing that's crazy, Jeb, we talk about this all the time. You and I do. Like I look at it and I go, okay, you get these numbers or your certain reports come out and you read 2-3 analysts. You're like, yeah, this economy is definitely slowing. It's definitely struggling, and real legit numbers. I'm not talking about someone spinning it, but then you get numbers coming out the next day and you're like, well, those are positive numbers. We really have sort of this bipolar economy right now where a lot of the data is weak, a lot of the data is strong, which is kind of this sort of muddle through the middle number. The Atlanta Fed keeps throwing out their GDP now, showing it above 3%. And I have 2 or 3 analysts that are not Debbie Downer pessimists that they look at and they're like, there's no way, dude. Like, look at these numbers. We're at best a 2% GDP economy here for Q4. So at some point, you look in, again, I don't count that COVID recession. There's a reason why you had that blip there in the first half of 2020. So if you look at that, we're going on 16 years since a recession. It has to come at some point. We've talked about heavy government debt load is deflationary over the long haul, and not necessarily deflationary, it's disinflationary because it limits growth, because money is not put towards productive purposes, either public or private funds. So you look at that and you're like, okay, so what I'm hearing is that we should have long-term growth at 1 to 2%, but magically coming out of COVID, we keep hearing we're getting 3.25, even though the underlying reports, the earnings calls from the companies when they're doing their quarterly earnings, like it doesn't jive. So it's not as bad as anyone paints on the downside, and it's not as good as anyone paints on the high side, but it gives you sort of this recipe for in the middle. And taking that back to what your question was, it doesn't lead to significantly lower interest rates if you don't see some weakness, and it certainly doesn't lead to lower home prices. People forget, unemployment's going to spike. If unemployment went to 8%, if it doubled from here, it's still 4 or 5% shy of where it was in the Great Recession. Like, that was not a normal recession. I think we are overdue for one, but I don't think we're due for anything like that anytime soon.
All right. Now we have Michelle. A question from Michelle just says she's at her job for 6 months, has an 800 credit score, has enough for a 20% down payment, asking if she can get a conventional loan if she's only been on the job for less than a year, but she has been in the same industry for the last 4 years, Josh. So same current job, 6 months, same industry, 4 years.
You could be on the job 6 days. It does not matter. If you change jobs within the same industry, it's upwardly mobile, you don't have a gap, it's not going to be a problem. So people get hung up with this, how long have I been on my job? No one cares how long you've been on your job. They care that you have an acceptable work history that doesn't show getting fired, laid off, long periods of not being able to get a job, or even industry hopping. If you had $300,000 a year jobs over the last 3 years with no gaps, but it was 3 very different industries, an underwriter might ask some questions of why you keep changing your career. But if you're in the same line of work, a new job is not problematic at all. We have people that literally were getting their first pay stub a week before closing.
All right, good stuff.
Well, hold on, Jeff. And again, she follows up.
Yeah, there you go, for 1 year.
So that is where the 6 months becomes important. Depending on the loan program, some of them will require you to be back on the job for 6 months. FHA is, again, hard and fast, 6 months back on the job. If you were off for a full year, a conventional loan, you may need that 6 months, you may not. It just depends on what was the situation, what was my explanation, why did I leave the workforce. So an otherwise really, really strong, well-qualified borrower, we might be able to get away with less than 6 months. But even with a 1 year gap, 6 months back on the job, FHA or conventional, you're going to be fine.
Yeah, just reach out to Josh using that referral link below, and he can put, information together for you to see exactly where you stand. So DCF has an interesting question here. Josh says, I've been trying to sell a co-op in New York City for about a year with no success. Do you guys think in 2025, question mark, advice to any viewers here, never buy a co-op ever. It's a
Jeff, we've
nightmare.
never done that video. We did condos versus SFRs. We've never done an episode on co-ops, and we probably never will.
So back in the day when I did loans, I remember I had people trying to buy co-ops in here in California. Co-ops, like New York, they're popular. They're not everywhere, but there's a lot of buildings that are co-ops. A co-op, what is a co-op, Josh? It's kind of like a timeshare to some degree, right? It's everybody in the building has ownership. Or they're all equal kind of owners, if you will. The problem with co-ops is financing is a nightmare. Not a lot of lenders do them. In fact, I don't know that they meet Fannie Freddie guidelines. Josh, you could tell me a little bit more about that, but there's just some nuances to them that make them very difficult for buyers to buy them, which limits your buyer pool and in turn makes it quote unquote a nightmare. So I don't know about 2025 if that's going to make it any better. I think that New York has been a pretty hot market recently, especially since the pandemic. So, I don't know that 2025 is going to change much, but, fingers crossed for you. Josh?
Not a whole lot, because we don't have a lot of them here. There are 2 or 3 buildings over in Long Beach, and they actually fall under this category of own your own, which is some lame half-assed co-op. It's not just your basic run-of-the-mill New York co-op that meets Fannie Freddie guidelines. So they can be very difficult when they're outside of that box. But we won't bore the rest of you with it because they're pretty.
So just asking. So a typical co-op, New York City, they meet Fannie Freddie guidelines.
Yeah.
Okay.
They can. It's not that they do. They can.
Got it. Okay. Fair enough. Let's go into a question here asking, how does one calculate to see what payment they would need to make, Josh, in order to pay off their home within a specified period of time? So say I had a 30-year fixed loan and I want to pay my house off in 15 years. How do I figure that out?
Mortgage calculator.
Right. Where would I find a mortgage calculator, Josh? Google. Any mortgage calculator will work.
Better yet, I'm going to go better than that because that's the old answer. That's the old man. That's the 2000s era. Go to ChatGPT, tell it, this is my mortgage amount. This is my rate. This is when I took it out. This is when I want it paid off. Please give me the required payment and amortization schedule. And in like 3 seconds, it will spit out the whole thing for you.
Do you have to say please when you're talking to ChatGPT?
I do. I worry the machines are going to come alive and murder me. So when they do awesome work for me, I say please and thank you.
I don't know that I say thank you, but I do say please.
I tell it how
every single prompt.
That's amazing. You did so well with that.
Oh, it's too good. All right. So there's your answer. ChatGPT is the answer. And that's actually a really good answer, Josh. It's funny. I know that GPTs are essentially going to take over Google at some point in searching. Like it's there because the information is so readily available. Perplexity and all of these different ones. I'm just not I'm not there yet. I'm automatic Google, like anything Google, when it should technically be one of those others. So, but anyway. I guess a question for you guys. If you're using ChatGPT right now in any form, any GPT, whether it's ChatGPT, Perplexity, Josh, I'm drawing blanks here.
Claude,
that's your
Gemini.
favorite. Gemini, yeah. Any of them. Let us know in the chat. And if you are, let us know why you're using them. How are you using them? I'm just interested. I'm interested in people using them and why they're using them.
It's funny, Jeb. I love everything Google, and Gemini, I just despise it. It never does what it's supposed to do, and it's awful. It's the worst thing ever.
It's funny. I now use like 3, and I type the same prompt into all 3, and I see what I get, and then I take all 3, and then I put it back into GPT, and then tell GPT to give me what I want. So I don't know. Anyhow, there we go. Sean followed up and said he worked with an in-house loan officer for new construction in 2022. There were no minimum payments on the books. So he said to estimate it. Most people likely underestimated them to maximize loan qualifications.
You don't get to estimate it. I can't say, hey, how much is your car payment? Just throw me a number. Okay, it's 300. We're going to get a credit report. And if there is no payment on there, we don't get to estimate it. We have to document it. And if it can't be documented, we do see the balance. And again, Freddie's going to let you do a 0.5%. Fannie's going to require 1% if you have zero. So it's going to get to an underwriter, and an underwriter is going to underwrite it. There is no builder in the United States of America that lends their own money and makes their own guidelines. They have to sell them in the secondary market. Could they close 100? Could they close 200? Could they close 500? Not calculating student loans correct? Yes, they could. And they're going to end up owning all of those loans because they're going to get QC'd and they're going to come back. You can always slip a loan, a couple loans through without following the guidelines, but the guidelines are the guidelines. It's not magic. No one gets to make up their own stuff. You can get away with anything for a few files. You're not getting away with that for a long time. So the loan officer you were talking to is a pretty good example of call center loan officer, person sitting on a new construction, just getting deals handed to them because you have to get approved with them. Like, they need to know those guidelines. The underwriter is going to know it behind them, and it's going to become a problem.
Yeah, I mean, he follows up basically saying he knows someone that did that and now they're screwed. I mean, it sounds to me like you probably have a lawsuit. If that was your deal and you were able to estimate, that's what they told you, that's huge. I mean, basically saying, yeah, if a lender's not following guidelines and they're telling you you're qualified based off that information, then I don't know. There's something else there. So not to say it didn't happen, just saying it seems, you would see a lot more properties distress going into foreclosure if that were something that were happening nationwide.
But Jeb, we hear things like this. I'm not saying this exactly, but you hear a scenario like this every 6 months, every 12 months. And here's the reality. You never saw your buddy's loan file, and your buddy doesn't know loans. So he can tell you what the guy told him and what happened. He doesn't know. He has no idea what happened in that file. So generally, someone did what they were supposed to behind the scenes and calculated it correctly. They met the guidelines. Debt to income ratio could have been really, really high. I do not believe there's any lender out there going, you know what, we want to move these houses so bad that we will risk buybacks on the back end. You go out of business very fast doing that.
Well, especially in a time where 3 years ago on a 3-2, like the housing market was hot 3 years ago. Like you didn't need to move houses like that.
Yeah.
But nevertheless, here we are. So I don't know that we have a lot. Here's a question, Josh. If someone wants to do a cash out refi of $100,000, they currently have a loan of $780,000. So it'd be a loan amount of $880,000. Does it matter how much the house appraises for? Or is that loan considered jumbo regardless?
The appraisal is always going to matter because they're not going to let you borrow an excessive amount of your home's value. So VA will let you go to 100%. Everything else is going to limit you to 80. So FHA, Fannie, Freddie, 80%. There are non-QM programs. There are portfolio programs out there, and some of them will let you go as high as 90%, but the appraisal is absolutely going to matter. And it's going to depend, if that is a jumbo loan, on where you're located. 880, so the new conforming loan limits are just over 800. So 880, you're well over it. But if you're in Southern California, you're in the Bay Area, you're in King County in Washington, you can go up over $1 million.
Yeah, and it's not considered a jumbo loan. So, so it depends on where you're located in the United States, will depend on whether that loan amount qualifies for conforming or non-QM or jumbo or what have you. So, all right. Let's see. What do we got here?
Jeb, I have a comment to a comment here. So Hellfire 0220 says, I have a bunch of your videos saved. Thank you for being so informative. So I like educating myself, but generally when I save the videos, I save entertaining videos. So Jeb, you have gone on to now escalate your videos to the status of being entertaining.
There you go. And here's what I'll say. Like, people like, dude, you must watch so much YouTube. I don't watch any YouTube. It's crazy. Like, Josh will come in and say, hey, did you see this guy on YouTube, or have you seen this video? And I'm like, no, I don't even really watch TV. It's really weird. I went from a time where I watched a lot of TV and was very informed on the world and the news and all of that stuff. Now I don't watch any news. I don't watch rarely any TV, little Netflix here and there. Sports I watch, and that's really about it. I'm kind of, I don't know. I don't know where that time went that I used to spend watching TV, but it doesn't show up in other areas. So,
well, I know you appreciate people downloading and watching and saving.
No, videos. I do. Yes, absolutely. Yeah.
Jeb, we've got a client just got clear to close. They'll be signing docs tomorrow. Came from the podcast that he said he found us 3.5 months ago, and he has listened to 60 hours of our content. And I said,
Wow.
you might take the crown. I don't know that we have anyone else that has listened in the last 3.5 months to 60 hours of Jeb and
You
I
might
talking
be
about
the
it.
educated home buyer.
He is
You
he's
might need
very
the, like the
educated.
belt. We might need a belt for this person.
Yes.
No, that's awesome. Excuse me. No, that's cool. So we only had like 4 people, Josh, that actually use Chat GPT in here. So we're on the cutting edge, clearly, because no one else is using it, or any GPT for that matter. All right, Josh, we have someone here saying that they talked to a lender and they said about USDA, and basically they were told that it's hard to qualify for. Is that true? So I guess what are the stipulations around USDA, Josh? You clearly want to laugh or say something that make it difficult to qualify for.
It's going to jog your memory, because every time you make a video saying something, we do a podcast episode saying something, or we talk about it here on the show, Big Brother USDA is always listening, and Jeb will get a call or an email from the girl at USDA saying, that's not true. We can totally do that. So I can tell you that probably the program that most people would be considering, hey, I'm going to go FHA. Oh, this home's USDA eligible. USDA doesn't require the 3.5% down payment, has a very similar interest rate and lower mortgage insurance. So if you could qualify for both, you'd probably prefer to have the USDA loan. But I can tell you that FHA in the real world, when it goes through underwriting, is much more flexible than USDA. So I don't think the underwriter is or the loan officer is steering you wrong here. If we're trying to maximize your qualification, you're limited in what you can do, you're going to qualify for more, most likely, under FHA than you would under USDA.
Yeah, and let's like overview what makes it difficult to qualify for. There are income requirements, maximum. You can't make more than a certain amount of money, which is a big problem with USDA. House has to be in a certain area, so not all homes qualify. Those are probably the 2 biggest things there, Josh. A little bit tighter debt to income ratios than FHA and some of these other loan programs. So just a little bit more stricter of but again, with that, it, but like you said, lower down, like no down payment, really good interest rates, lower MI. There's a lot of good features to it, but it's if you don't fit in that little box, it unfortunately it's not there.
Jeb, Albor 350Z came back, said you're in Southern California. Well, you're in luck. We have a little crawl there at the bottom of the screen.
Yep.
Reach out. You're going to be able to go to almost 1.2 million. So your 880 loan amount is not a problem, but use that, get in contact. We'd love to work some numbers for you.
Very good. Now, all of Southern California, Josh, what about, is it San Bernardino on one of those, like, doesn't qualify for high costs?
Riverside and San Bernardino do not have high costs. San Diego has them, but not the full high cost. They're over $1 million now, but not full high cost. I mentioned King County in Washington, over $1 million, but not full high cost.
So just because you're Southern California doesn't necessarily mean you're good, right? It's Orange County, Southern California, LA County, Southern California, but yeah. So reach out.
Either way, Albor, we have a credit union, an exclusive credit union relationship where we can do 80 to the high balance limits anywhere you're at. So give us a call.
All right. There you go. Peace Pause says, is there any closing costs? Well, let's
isn't that redundant? Peace Pause.
Peace Pause.
It's peace.
Peace.
Yeah.
I don't know. What is that? What pause means?
Yes. Did you not in North Carolina? Do you not have to take Spanish for 2 years?
I mean, yeah, but we don't talk about peace in there. We talk about, como se llama and, that sort of thing. Like we never learned. We never got to peace. We never got to peace, Josh.
Right.
Is there any type of anywhere, Josh? Is there any sort of discount for closing costs for nurses, for doctors, for anyone? Just in general.
None that I am aware of. That does not mean that they don't exist. In the past, they've existed. We used to, in California, in addition to Cal HFA, we had Cal STRS. So Cal STRS members could qualify for Cal STRS loans. Even at that, Cal HFA had educator loans. They had first responder loans. I am not aware of any of them. It doesn't mean that it doesn't exist. If you know specifically where you would like to buy, talk to your HR, see if they are aware of any, or if they have any lenders that they could connect you with. In general, I'm biased. Just reach out to a broker and see what they can put together for you. But they're few and far between. I'm not saying you can't find it, and I'm not saying you shouldn't do your research. But if you Google the heck out of it and you don't find anything, it probably doesn't exist in your area.
Good stuff. Smart Fox says, want to buy a $1.5 million house with $1 million down. Can I qualify with a 4-year history of part-time work? Investments, about to retire in 2 years. How would a lender look at this? So Josh, we're talking 33% loan to value. What is a lender looking for here?
It's for standard loans. So when you're looking for a 33% loan to value loan, someone will loan you that money. Someone at some rate will loan you that money. So can you get a loan? You can absolutely get a loan. Can you get a good loan? Fannie, Freddie, FHA, VA, any of that stuff. They don't care that you have an ultra low loan to value. They will let you go to the max of their limits in terms of debt to income. They're probably going to be far more forgiving. And when we talk about, the minimum credit score on a Fannie Freddie loan is 620. Well, if you have a 620 credit score, you're probably not getting approved for a 3% down loan. But if you're putting 67% down, no problem getting approved. So the question just comes down to, when you say 4 years of part-time work, okay, we still have to go to the debt to income ratio. They don't look at it and go, hey, I'll let you go to a 70% debt to income ratio because it's such a small loan and we know you're not going to lose the house that you put $1 million down on. We're going to have to run the income calculation with part-time work. If it's 20 hours a week, week in and week out, that's an easy calculation. That's not variable income, even though it's part-time. But if it's 1 week is 22, 1 week is 18, 1 week is 23, now we got to go back and look at the last 2 years and average that. So we're getting into a good part of the year for that, because generally once we have 18, 20 months, we don't have to go back to the year before that, which can be good or bad for you. But it sounds like you have a unique situation and you should talk to an expert loan officer that can walk you through that.
Good stuff. Moneybag says, do we forecast modest appreciation 2025? We started the episode tonight by talking about appreciation. So go listen to the first 3 minutes of tonight's episode. You'll get our take on appreciation and thoughts there. So hopefully that's helpful. Josh, this is a question that came in. Says, I have a credit score above 790. And my financial advisor said I could bargain with lenders. What parameters can I bargain with? So Josh, what is bargainable in a loan process going through a pre-approval? What can you actually try to bargain with the lender on?
We actually had this question yesterday. It was a jumbo loan and a borrower who had a significant chunk of money. So they could go, he had checked with 3 or 4 different banks and he was getting these numbers that were great. He's like, I really like you. I would like to work with you, but I'm getting this number from this bank if I put $1 million there. I'm getting this number from this bank if I put $500,000 over there. So what can you do on these numbers that you gave me? I said, we put our best foot forward from the beginning. I don't play let's make a deal. So are there lenders out there that do that? They want to give you a high number and then, oh God, this one is going to actually bargain. We're going to haggle our way down. So if you go to Chase or B of A, that loan officer probably doesn't have the ability to do that. They have a posted rate sheet and that's what it's going to be. A true broker that is not closing in their own name, they don't have a lot of flexibility. They set their comp plan and they can get the best comp plan, meaning the lowest compensation to them with their best priced lender and put that best foot forward. What I would say is, again, when we're quoting people, we're going to put our best foot forward and give you the right numbers up front. If to you, this is just a commodity and your loan is so easy that no one could screw it up and you don't care about having the best experience, having good communication, knowing what's going on, getting what you were told you were going to get up front, then by all means, go get 5 or 6 quotes, tell everyone who the best quote is, fight them, have them fight it out and see who will do the loan the cheapest. I think that your mortgage is a little bit more important, especially if it's a purchase. If it's a refinance and you want to play the game and see, hey, can I get the lowest rate? Can I call a kid in the call center and put it together? There's not as much to risk or lose there. But on a purchase, I would be very careful with it. And I would also be careful about working with someone. They said, hey, the rate's 6.99%. You go, well, I've talked to 4 other lenders. What's the best you can do? Oh, I could actually do 6.499. You know what I'm saying? It's going to come down to your preference of how much you want to haggle. And if the person in the channel is in a channel, the person you're working with is in a channel where they have flexibility and ability and willingness to do that.
Following up, same person's asking, what's the difference in a regular broker and one that does wholesale lending, Josh? Is there a difference?
The one that's telling you they have something special, a unique type of brokering, is either full of shit or just lying to you. All brokers operate in the wholesale channel. We have a menu of wholesale lenders with which we can work. Some brokers are set up with 3 wholesale lenders. We have about 75. And the more common is somewhere in the 10 to 20 range. So you probably want to ask them, how many investors do you have? And then how many wholesale investors have you closed loans with in the last 12 months? There's not a right or a wrong answer, but it's a good one to just divulge why are they working with who they're working with, who is your loan most likely to be with.
Good stuff. How long does it take for late payments for a mortgage to age on your credit report? So Josh, if you get a 30-day late, 60-day, 90-day, how long is that going to impact your credit score?
It's going to impact it for 7 years. The late will fall off at 7 years. Now, after you bring it back current, your credit score will heal. After it's been 12 months, your credit score will heal. 24 months, better still. And it will keep getting better right until the bitter end. But I've seen someone, have a mortgage late 6 years and 10 months ago, and they come back as soon as that thing falls off and they get a 30, 40 point boost. So I can tell you there is a negative consequence to it all the way until it falls off. The secondary question there is, how long does it impact my credit score? How long does it impact my eligibility? Most loan programs with an automated approval, you could have a 30-day late within the last 12 months. Once you get more than 30 in the last 12, more than 130, or if you go 60 days late in the last 12 months, it can prevent you from getting a loan.
Here's a question, Josh. It's going to be a little bit difficult to answer, but we're gonna try it because it's detailed and I like the question. It says, "Hey guys, I took a deal using Lennar, basically their in-house builder, who locked their rate on November 29th. She said that the best they could do was 7 1/8, so 7.125. But Tyler decided to buy down his rate. He's paid $8,200. It was 2.68% origination point, so he bought it down 2.68 points." And it got him a 6% rate. So his question is, did they start me off at a higher than normal rate in your opinion? So back on November 29th, 7 1/8, was that reasonable? It seems reasonable, maybe a little bit higher, but not anything crazy. What are your thoughts there, Josh?
Same. I'm just looking here at Mortgage News Daily. They have their fun little chart where we can use it as a little bit of a time machine. So we're saying November 29th, the very end of November. Were rates any better? Rates pretty much essentially where they are today. So yeah, I mean, that rate should not, with 0 points with a 790 credit score and over 20% down, should have been 6.5 would have been real good. 6.75 would have been okay. So it's interesting because what we generally see are you using $8,200 of your own money, or are you using their money? Because this is the game that they like to play. They have shitty rates. They're offering you shitty rates, but then they're saying, here's a bunch of monopoly money to buy it down to an amazing rate. So that's most likely what happened. I don't think they were manipulating it upwards. They just have bad rates. And again, they hand you a lump of monopoly money and go, here, buy it down to a great rate.
Yeah, exactly. My guess is probably buying it down with their money, but guessing there. Veronica currently has 6 years left of a 15-year conventional loan and wants to relocate to South Carolina and keep property as a rental. Will I qualify for an FHA loan on the next property as a primary home? So Josh, if you're moving, it looks like you got a conventional loan. This will be the only FHA loan. Is there any issue there?
So the only requirement you have there with FHA is the FHA 100-mile rule. So as long as relocating to South Carolina is more than 100 miles, you will be able to convert that to a rental. So that would be the biggest question. So it sounds like South Carolina is not close to you right now, so you should be okay.
All right. Willing, one of our regular viewers, just came in and put his name. Just said willing. I just thought
I'm willing. What's he willing to do?
That's just want to put that in there. But did follow it up with the question. How do you know land value from house value, Josh? So, oftentimes you'll look at your tax bill, right? And it has land value or value or something. And it's often way less than what you owe on your home. How does one determine land value in something like this? I mean, the tax assessor typically, in my opinion, underestimates land value. But how would one go about figuring out what the land's worth? Any idea?
I think the appraiser makes a stab at it in the appraisal, but looking up the assessed value will separate them out. But again, most parts of the country, even though they've been going up, the assessments are just wildly inaccurate relative. People will pull up their assessed value. So I think I use this example. My father-in-law is considering selling a property he has that's on a lake in Washington. It's bitchin' property, and guy down the lake said, "Oh, I like your property. I want to buy it." And said, "Okay, cool. We don't need any realtors or anything. I'll just give you the assessed value for it." It's like, come on, buddy. It's assessed for like $250,000 less than it's worth. So, more importantly, why do we care? Why do we care what the land value is?
So he said somebody wanted to build and demolish and build a new home, but nevertheless, we'll
get an appraiser involved at that point, because you're concerned because you want to know what the land value is to be able to attribute it to the construction loan on the way in. So that at that point, it is important, and nothing you're going to be able to do is going to get you a super accurate number on the land value. Just get an appraiser to do a value check for you.
All right, Josh, we've been in an hour, but I'm going to throw out this comment here just because this is often, Robert comes in and says unconventional thinking. We don't have a shortage of homes. We have a mom and pop international hoarding of homes as investors. So let's just, so there's two ways that people get this all screwed up. One is that corporations are basically buying all the homes. Understand that corporations own less than 1% of all residential real estate. So the corporations are not your competition in most cases. Now, in some markets, they have a little bit bigger presence, but at the end of the day, they're not buying all the homes. Secondly, I think once you count in mom and pop investors and all of that, Josh, I think it's like 3% of homes are investment properties, something like that. It's a low number, which means, again, these people are not your competition. That is not the shortage of homes out there in the market.
I just posted in the comments. I don't know if you read Malden this last weekend, but the theme of Thoughts from the Front Line was homes for Christmas. He did a deep dive on this. He put links to all of the best research on this. Take the tinfoil hat off. The investors are not the ones keeping homes being unaffordable.
And you just went out of focus for some reason.
Oh, that did it to me the other week. We can't have me out of focus.
You got to get closer. Do it again. It's your mic. Your mic's what's in focus. There you go.
Oh, there we go.
Nope,
keeps going away. I got to keep my ugly face. I have to stare in the camera like this.
All right, guys. It's been 1 hour. We'll be back next Wednesday, the week before Christmas, with another update on the Educated Homebuyer. If you didn't listen to the Educated Homebuyer podcast this past week, we talked about Trump and mortgage rates. Go listen to that. Until then, adios, amigos.
That's just wrong. Thief. He's a thief.